here to discuss how PIMCO is positioning portfolios across global asset classes and other key takeaways from our latest asset allocation outlook. I'd like to start by providing our overall risk posture in multi-asset portfolios today. We are overall underweight risk given our expectation that growth will slow in the coming quarters as the lagged effects of tighter financial conditions lead to a recession in the US by year-end. That said, the volatility across markets experienced over the last year, coupled with the repricing across asset classes, has created some compelling investment opportunities, particularly in fixed income markets. Looking more closely at each asset class, we remain cautious on equities. Equities look expensive when considering the macro environment, and we think that earnings estimates are still too optimistic and valuation multiples are still too high. Additionally, equities have historically underperformed heading into recessions. From a sector perspective, we favor more defensive businesses such as healthcare and consumer staples. One bright spot is emerging markets, most notably emerging market Asia, which we expect to benefit from the China reopening story that we think will continue to play out through the rest of this year. Turning to fixed income, our views on rates and high-quality credit are more constructive. As we note in our outlook piece, bonds are back, and we think that fixed income is benefiting from higher yields, decelerating inflation, and the fact that policy rates are approaching their terminal level. In our view, high-quality bonds typically perform well heading into a recession, and we believe that this will be the case this time around as well, now that inflation is starting to show signs of coming down. Our bias is to own higher quality credit, given our fundamental expectation for further economic weakness, and we particularly like mortgage-related credit and securitized credit. We also see value in maintaining high-quality liquidity in our exposure in order to be able to step in opportunistically when dislocations occur. Within real assets, we hold a fairly balanced view today. Commodities, while they potentially offer a good inflation hedge, they're oftentimes sensitive to economic growth, so we're cautious on positioning in light of that. Where we see more value right now is in tips, and they potentially offer an attractive way to hedge inflation risk given that markets are right now pricing in fairly modest long-term inflation expectations. Lastly, I wanted to touch on PIMCO's outlook for the dollar and other currencies going forward. We're underweight the dollar. We believe that it looks expensive from a valuation perspective and anticipate that some of the previous tailwinds, such as the stronger relative U.S. growth, as well as the yield advantage of the U.S. rates versus the rest of the world, have started to fade away. We favor select emerging market currencies, given cheap valuations, attractive carry, falling inflation, and improving fundamental and technical factors.